In April 2013, gold prices dropped nearly 15% in 2 trading days, the largest decline in 30 years. Physical gold dealers reported something peculiar during this collapse. They couldn't keep bullion in stock. Customers were buying physical gold faster than dealers could source it, paying premiums above spot price to secure actual metal. Meanwhile, futures markets where paper contracts for gold trade showed massive selling pressure, driving prices down. The disconnect was striking. Physical markets suggested shortage and high demand. Paper markets indicated surplus and panic selling. How can the same commodity simultaneously experience scarcity in physical form and glut in financial form? The answer lies in understanding the difference between gold as a physical asset and gold as a financial instrument, a distinction that matters enormously for how gold prices are determined, who influences those prices, and what those prices actually mean. The paper gold market, where claims on gold trade far in excess of physical gold that exists, operates on mechanisms that most gold buyers don't fully understand. This isn't a secret conspiracy. It's documented market structure with real implications for anyone treating gold as a store of value or a hedge against monetary uncertainty. Understanding how paper gold works, why it exists, and what risks it creates requires looking beyond simplified narratives about manipulation or scams and examining the actual mechanics of modern commodity markets. Gold has functioned as money and store of value for thousands of years, but how we trade gold has transformed dramatically over the past century. For most of history, owning gold meant possessing physical metal. If you wanted exposure to gold prices, you bought coins or bars and stored them. This changed with the development of futures markets in the late 1800s and early 1900s. Futures contracts allowed farmers to lock in prices for crops before harvest, and merchants to hedge against price fluctuations. The same logic extended to metals. Rather than buying and storing physical gold, investors could purchase contracts representing claims on future delivery of gold. These contracts traded on exchanges, could be bought and sold easily, and didn't require dealing with the logistics of physical storage and insurance. For many market participants, this was genuine innovation that improved market efficiency and liquidity. For others, it created a system where financial claims on gold could multiply beyond the physical gold available to satisfy those claims if everyone demanded delivery simultaneously. Both perspectives capture something true about how paper gold markets function. The scale of paper gold relative to physical gold is where the story becomes remarkable. Estimates vary, but most analyses suggest that paper claims on gold, through futures contracts, allocated and unallocated accounts, exchange-traded funds, and various derivatives, exceed physical gold available for delivery by substantial multiples. Some estimates suggest ratios exceeding 100 to 1, meaning for every ounce of physical gold, there are more than 100 ounces of paper claims trading. These estimates are controversial and difficult to verify precisely because much of the gold market operates through unallocated accounts and over-the-counter derivatives that are transparently reported. But even conservative estimates acknowledge that paper gold substantially exceeds readily available physical gold. This isn't necessarily fraud, it's how fractional systems work. Your bank holds claims on deposits that exceed the cash it keeps in vaults, relying on the statistical likelihood that not everyone will withdraw simultaneously. Paper gold markets operate on similar logic. Most contract holders will settle financially rather than demanding physical delivery, so the system can function with far less physical gold than total claims. The question is, what happens when this assumption breaks down? The mechanics of how paper gold trades matter because they determine who can influence prices and how. Gold futures trade on exchanges like COMEX, part of the Chicago Mercantile Exchange Group. Market participants include commercial hedgers, mining companies locking in prices for future production, or jewelry manufacturers securing supply, and speculators who have no interest in physical gold but trade contracts to profit from price movements. The volume of speculative trading dwarfs the volume of commercial hedging. On a typical day, the notional value of gold futures traded can exceed the value of all gold mined globally in a year. This creates a situation where prices are determined primarily by financial flows, speculators buying and selling contracts, rather than by supply and demand for physical metal. Commercial users certainly participate, but they're minority players in a market dominated by financial speculation. Critics argue this allows prices to be manipulated or at least heavily influenced by large traders with no connection to physical gold markets. Defenders counter that this liquidity is precisely what makes hedging viable for commercial users and what allows efficient price discovery across global markets. Both arguments have merit, and the implications depend partly on what you think gold markets should accomplish. The difference between allocated and unallocated gold accounts illuminates how physical scarcity can coexist with paper abundance. Allocated gold means specific bars are assigned to you, sitting in a vault with your name associated with them. You own that physical metal, Unallocated gold means the bank owes you gold but hasn't assigned specific bars. You're a creditor of the bank, holding a claim they'll deliver gold on demand. Most gold banking operates on an unallocated basis because it's more efficient for the institution. They can run fractional reserves, holding less physical gold than total claims. This works fine until many claimants simultaneously demand physical delivery, at which point the bank faces a problem it may not be able to solve without acquiring gold at potentially unfavorable prices. The 2013 example illustrated this dynamic. Financial markets could sell unlimited paper gold, driving prices down, but physical dealers couldn't source enough metal to meet demand at those lower prices, creating the disconnect. The resolution came through prices eventually rising enough that physical became available, but during the dislocation, the price signals from paper and physical markets contradicted each other. Central bank gold holdings and leasing arrangements add another layer of complexity that affects both physical availability and price dynamics. Central banks collectively hold roughly 35,000 tons of gold, representing about 20% of all gold ever mined. Much of this gold doesn't sit idle in vaults. Central banks lease gold to commercial banks, who sell it into the market and invest the proceeds, earning returns that exceed the leasing fees. The lessee owes the gold back to the central bank, but in the meantime, that same gold has been sold to someone else who believes they own it. This creates a situation where the same physical gold backs multiple claims. The central bank owns it, the leasing bank owes it, and the purchaser holds it. All three balance sheets show gold assets for the same physical metal. Critics describe this as a mechanism for suppressing gold prices by increasing effective supply beyond actual physical production. Defenders note that central bank leasing provides useful liquidity to markets, and that lease rates reflect the cost of this service. The practice is disclosed, if not widely understood, and represents another way that paper claims can exceed physical availability without requiring any fraud or conspiracy, just normal financial operations that create leverage in the gold market. Exchange-traded funds like GLD brought gold investment to mainstream investors by offering stock-like shares backed by physical gold held in vaults. These products are marketed as providing exposure to gold prices without the hassle of physical ownership. But examining the fine print reveals nuances that matter during stress. Most gold ETFs allow for redemptions only by authorized participants in large increments, typically 100,000 shares, representing about 10 tons of gold. Retail investors can't redeem shares for physical metal. They can only sell shares back into the market at prevailing prices. This creates asymmetry where institutions can potentially redeem physical, while retail holders can only access paper value. Additionally, the ETF's prospectuses contain language allowing for cash settlement under certain circumstances, meaning even large holders might not receive physical gold if the fund faces delivery problems. These aren't hidden terms. They're disclosed in prospectuses that few people read. But they matter because they mean that owning GLD shares isn't equivalent to owning physical gold, even though the marketing suggests similar exposure. During normal markets, the difference is academic. During a crisis where physical gold becomes difficult to source, the difference could be substantial. The question of whether paper gold markets manipulate prices downward is where advocacy and analysis become difficult to separate. Documented cases exist of traders manipulating gold and silver prices through spoofing, placing large orders they intended to cancel to move prices, then trading on those artificial movements. Deutsche Bank, HSBC, UBS, and other major banks have paid fines for such behavior. These aren't allegations. They're settled cases with admitted wrongdoing, so manipulation has occurred. The question is whether it represents occasional bad behavior by individual traders or systematic suppression of prices serving institutional interests. Critics point to patterns of price declines during thin trading periods like Asian hours, suggesting coordinated selling designed to trigger stop losses and create cascading declines. They note that 4 major banks dominate gold derivatives trading, creating concentration that could enable collusion. They observe that central banks and commercial banks benefit from low gold prices. Central banks because high gold prices suggest monetary instability, commercial banks because they're short gold through leasing arrangements. These observations are factual, but the interpretation that they prove intentional price suppression requires connecting dots in ways that reasonable people disagree about. Defenders note that concentrated markets are common in commodities. The price declines during thin trading could reflect normal market dynamics rather than manipulation, and that any systematic suppression would create profit opportunities for those betting against it. The debate continues without definitive resolution. The relationship between gold prices and currency values creates another dimension where paper markets influence outcomes. In theory, gold serves as a hedge against currency debasement. When fiat currencies lose value through inflation, gold should rise to maintain purchasing power. Historically, this relationship holds over long periods but breaks down over shorter timeframes. During the 2008 financial crisis, gold initially fell along with everything else despite massive monetary expansion, only rallying later. During COVID, similar patterns emerged. The disconnect occurs partly because gold futures can be sold to raise cash during liquidity squeezes, regardless of gold's fundamental role as monetary alternative. When hedge funds face margin calls, they sell what they can, including gold futures. This forced selling can temporarily overwhelm the flight to safety buying that theory predicts. Over time, as liquidity stabilizes and monetary expansion translates into inflation concerns, gold typically rallies. But the short-term volatility can shake out investors who expected gold to protect them immediately during crisis. Understanding this timing mismatch matters for anyone holding gold as insurance. The protection works over longer horizons, but might not work when you need it most urgently during acute crisis phases. The practical implications for investors considering gold exposure come down to understanding what you actually own and what risks you're accepting. Physical gold held in your possession or in allocated storage provides direct exposure with counterparty risk limited to theft or storage facility failure. You pay premiums over spot price to buy, storage and insurance costs to hold, and bid-ask spreads to sell. It's inefficient and expensive compared to paper alternatives, but you own the actual metal without depending on any institution honoring obligations. Unallocated gold accounts offer convenience and lower costs, but introduce counterparty risks. You're trusting the institution to deliver if you request physical, and during stress, that trust might be misplaced. Gold ETFs provide liquid exposure through stock markets, but with the asymmetries around redemption and potential cash settlement. Gold futures offer leveraged exposure with low capital requirements, but require active management, carry rollover costs, and rarely involve physical delivery. Each vehicle has appropriate uses depending on objectives, but conflating them causes problems. Buying GLD shares, thinking you own gold equivalent to physical holdings, misunderstands what you actually own. The question of whether the paper gold market represents a scam or legitimate financial innovation depends largely on transparency and whether participants understand what they are buying. If someone purchases unallocated gold thinking they own physical metal that will be available on demand, they've been misled, either through deceptive marketing or their own misunderstanding. If they know they're buying a claim that's only good if the institution remains solvent and able to source gold, they're making an informed choice about the trade-offs of cost and convenience versus security. The terminology matters here. Calling it a scam implies intentional fraud. Calling it fractional reserve banking for gold implies a system that works most of the time but carries risks during stress. The evidence suggests the latter is more accurate than the former. The system isn't designed to defraud, but rather to provide liquidity and efficiency, accepting counterparty risk and delivery risk as trade-offs. Those risks are disclosed, though perhaps not emphasized as strongly as buyers might need to understand them. Historical episodes where paper claims exceeded physical availability offer lessons about how these systems break down. The London gold pool in the 1960s attempted to suppress gold prices through coordinated selling by central banks, ultimately failing when physical demand overwhelmed the pool's resources. The gold price subsequently multiplied. The Hunt brothers' silver manipulation in 1980 created massive paper short positions that ultimately collapsed when physical delivery could not be avoided. More recently, the periodic shortages of physical gold coins and bars during price declines suggest ongoing tension between paper markets and physical availability. Each episode reinforces that paper markets can diverge from physical reality temporarily but not indefinitely. The question is, how long divergences can persist, and what happens during the adjustment when paper claims try to convert to physical and discover insufficient supply exists at prevailing prices? Theory suggests prices should rise until enough holders accept cash settlement or new supply enters the market. Practice suggests violent volatility and potential for cascading failures if enough participants demand physical simultaneously. The regulatory environment around gold markets has evolved in ways that affect these dynamics. The Dodd-Frank Act after 2008 required more derivatives, trading to move to clearinghouses and exchanges rather than bilateral over-the-counter contracts. This increased transparency, but also increased margin requirements and operational complexity. Position limits in futures markets restrict how large any single trader's positions can grow, theoretically preventing manipulation, but also reducing ability of commercial hedgers to fully hedge risk. The London Bullion Market Association sets standards for good delivery bars and maintains the daily fixing process that establishes reference prices. These regulatory structures aim to balance market integrity with liquidity and efficiency. Whether they succeed is debatable. Critics argue that concentration among a few major banks persists despite regulation, that enforcement is insufficient, and that captured regulators protect incumbents rather than market fairness. Defenders note that markets function smoothly most of the time, that liquidity is abundant, and that the regulatory regime has improved transparency compared to previous eras. The debate reflects broader disagreements about how much regulation markets need and whether existing regulation helps or hinders outcomes. The rise of cryptocurrency, and particularly Bitcoin, has introduced an interesting comparison point for debates about gold markets. Bitcoin advocates argue that their system solves the paper gold problem through cryptographic proof that eliminates counterparty risk and makes fractional reserves impossible. Every Bitcoin exists on a distributed ledger. You can verify supply and ownership without trusting institutions. This makes Bitcoin similar to physical gold. What you own exists independent of others' claims. But Bitcoin's volatility, regulatory uncertainty, and dependence on functioning infrastructure create different risks than physical gold. The comparison illuminates trade-offs rather than providing clearly superior alternatives. Some investors hedge both ways, holding physical gold and Bitcoin as different forms of non-fiat assets with different risk profiles. The point is that one is clearly better, but that understanding the specific risks and benefits of each allows more informed decisions than treating them as interchangeable. Looking forward, several developments could affect the paper gold market's structure and stability. Central bank digital currencies might change how monetary systems function and whether gold retains its role as monetary alternative. Increasing investor awareness of counterparty risks might drive more demand for physical overpaper, potentially straining the fractional reserve model. Greater price volatility driven by algorithmic trading and leveraged speculation could create more episodes where physical and paper markets diverge. Alternatively, continued smooth functioning might reinforce confidence in paper markets, allowing further leverage and continued growth of paper claims relative to physical. Predicting which trajectory materializes requires forecasting both investor behavior and institutional responses, neither of which is reliably predictable. What seems clear is that the current structure, where paper claims substantially exceed physical availability, will persist until either it doesn't, at which point adjustment will likely be rapid and disruptive. The practical question for anyone holding or considering gold comes down to what role it plays in your broader financial picture and what form best serves that role. If gold is insurance against monetary system failure, physical metal in your possession or unallocated storage provides the most robust protection at the cost of efficiency and yield. If gold is a trading vehicle to capture price movements, futures or ETFs offer liquidity and lower costs at the expense of counterparty risk and complexity. If gold is a small diversification component of a portfolio, the choice matters less because the overall portfolio isn't dependent on gold performing any critical function. The mistake is treating paper vehicles as equivalent to physical while expecting physical-like security during stress. They're different instruments with different risk profiles, and clarity about those differences enables better decisions about which is appropriate for your situation. The narrative that paper gold markets represent a vast conspiracy to suppress prices and defraud investors oversimplifies a complex system with legitimate purposes alongside real risks. Yes, manipulation has occurred, documented and settled. Yes, fractional reserves create vulnerability inherent in the structure. Yes, conflicts of interest exist. Central banks and commercial banks benefit from low gold prices. But these facts don't necessarily prove intentional, coordinated, systematic fraud. They prove that markets are imperfect, that institutions act in self-interest, and that systems designed for efficiency create fragility. Understanding the actual mechanisms, how futures work, what allocated versus unallocated means, why paper claims can exceed physical, provides more useful knowledge than narratives of victimization or conspiracy. The system isn't designed to help you specifically. It's designed to serve various interests, including, but not limited to, retail investors. Knowing this, you can navigate the system more effectively by understanding what you're actually buying and what risks you're actually taking. The relationship between paper and physical gold will likely continue evolving as markets develop and technology changes. Blockchain-based precious metals trading could potentially improve transparency and reduce counterparty risk. Increased regulation might limit leverage and reduce the ratio of paper to physical claims. Growing distrust of financial institutions might drive more investors toward physical holdings. Or the status quo might persist indefinitely, with periodic stress episodes that resolve without fundamental change. Predicting which occurs requires abilities none of us reliably possess. What we can do is understand the current structure well enough to make informed decisions about whether and how to participate, accepting the risks we understand rather than risks we didn't realize we were taking. The paper gold market isn't fundamentally a scam designed to fleece investors. It's a financial system with legitimate functions and inherent vulnerabilities, operating in ways that benefit some participants more than others. Understanding who benefits, who bears risk, and what your position is within that system is empowerment. Claiming secret knowledge about inevitable collapse is something else entirely. The difference between these approaches is the difference between financial education and fear-based advocacy. Both might lead to similar conclusions about holding physical rather than paper gold, but one gets there through understanding, while the other gets there through manipulation. In a domain where clarity is rare and agendas are common, choosing understanding seems like the more reliable path.